Welcome to Founder Files, the podcast for growth minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI powered and human led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. Welcome back to Founder Files. Tech founders talk about contract value all the time, but most don't actually understand how this translates into revenue. And the gap is exactly where bad decisions, broken controls, and stakeholders' red flags come from. Today, we're breaking down SaaS revenue recognition simply and practically, how bookings, billings, and revenue really differ, why invoicing is not just a back office task, and how relevant metrics are calculated for subscription revenue models. If you're building toward a board-level finance function, this episode will change how you think about revenue and data processing. I'm joined today by Suezann Holmes, founder and CEO of ScaleXP. She's an award-winning CEO, CFO, and board advisor with experience spanning from well-established businesses such as Virgin Media and Virgin Mobile to early-stage tech top 100 companies. She's also a chartered accountant with a background in computer science from UT Texas and an MBA from Wharton Business School. Thank you so much, Susan, for being here today. And you're Texan, just like me, right?
Exactly. Yes. Well, I'm so excited to be here. Thank you. Thank you for the invitation.
I'm super excited to do this today. And I want to start the episode by telling you a quick story or a quick conversation that I had with a founder recently who told me that they had $5 million in revenue. But then when I looked at their financials, I realized that it was only about half of that. And then when I had the chance to dig deeper into their data, I realized that he was talking about bookings. So to get started with this episode, I would love for you to say, why is it important to understand differences between bookings, revenue, and billing?
Absolutely. So I think fundamentally there's two reasons that revenue is kind of fundamentally important. Number one, it's a great way to kind of understand how much money your company is actually earning every single month. And number two, I also, as a CEO, find it really helpful to kind of also just use that number to kind of keep my eye on the cash burn rate. So the revenue recognition is the allocation of revenue that your company has actually earned in the month. If you have a 12-month contract and someone pays up front, say $12,000 for the 12-month contract, every month you earn $1,000. Obviously, $12,000 over the 12 months. But knowing what you actually earn every month helps you understand your profitability, if your actual revenue is increasing from month to month. If you have any usage-based metrics, it helps you understand if your usage is growing. And quite frankly, it is the true measure of kind of actively customers are using your platform and if that usage is increasing over time.
That's great. So what is the difference between this revenue and the actual contract value, which is what usually people refer to when talking to investors or stakeholders?
Yes, absolutely. So in the example that I just referred to, let's just say that it's a 2-year contract. So in that case, your contract value over the 2 years would be, say, $24,000. So $1,000 a month for 2 years. Perhaps you send one invoice at the start of year one, a second invoice at the start of year two. In total, you're earning $24,000. But it's important to recognize that, your company hasn't really earned all that money until the full 2-year period has passed. So in this example, the total contract value is $24,000, but you're actually earning $1,000 each and every single month over the 24 months.
Do you think that it's also important to include bookings or contract value in the metrics when maybe speaking to stakeholders compared to how revenue is recognized?
Yeah, so they have really different purposes, and bookings and contract value tend to be a leading metric. So they really speak to how much revenue your company has in the bag over many months or even years into the future. So you know that if your bookings and your total contract value are going up, you're heading in the right direction. But it doesn't say anything about how quickly you're going to get there. And just to go back to that example of, you can have a total contract value of 24,000. that doesn't necessarily tell you if you're going to earn that 24,000 in 1 year, in 2 years, in 3 years, in 5 years. So I would say that bookings and contracts value absolutely is very important. It's a good leading metric to where the company is headed. And it is very nicely kind of counterbalanced by your revenue, which is kind of where you are today. And if your total contract value is increasing and your revenue is increasing every single month, then you're headed in the right direction. If one is increasing and the other one's not increasing, that's when it's always worth digging a little bit deeper. So really you're looking for them both to trend up, all the time. But if that's not the case, it's always worth investigating.
I totally agree. So if we were to think about how this whole process works, it obviously always starts with that contract, that deal that closes. And obviously you have the accounting process when you have to recognize your revenue property, but in between there is billing also and invoicing. So why can we talk more about that, and why is invoicing not just a back office task, and how can it be used to streamline that process from the day the deal is closed to billing to how you recognize revenue?
Yeah, absolutely. So I don't think invoicing is, I mean, the invoicing function, let's call it a preparing and sending out the invoice can be considered a back office task. But the data that's derived from that invoice is in fact hugely valuable. It's probably the single most valuable piece of data that sits in the accounting system. And the reason is because from the collection of all the invoices, what you know your monthly recurring revenue, you know your annual recurring revenue, you know your customer lifetime value, you know your net revenue retention, you know your upsells, you know your downgrades, you know your churn. Quite frankly, if you make a list of the top 10 SaaS metrics, every single one of them, with the exception of one, is derived from your invoices. It is the foundation of really understanding kind of business performance. So it's gold dust in terms of the data that's derived from those invoices.
So in terms of process, what is the best way to not make mistakes when it comes to invoicing? If it's a really important data source, a lot of times we see founders or companies just easily link their CRM into the accounting software and estimate that, the invoices would be automatically generated based on contract. What is the best process to set up to not make mistakes when it comes to invoicing and also revenue recognition?
Yeah, absolutely. So I'll handle those differently because they can be slightly different. I think at the end of the day, the invoicing, let's call it cadence, is set by what your customers want. So some customers want to be billed monthly, some customers want to be billed quarterly, some customers want to be billed annually. Um, to be frank with you, they're your customers and you should just accommodate whatever they want and to have the kind of processes that allow you to do that easily. So I would say the invoicing cadence, your customers will tell you what they want, go with it. In terms of the revenue recognition process, kind of once your customers tell you what they want and you go with it, you just need to make sure you have a kind of straightforward process to kind of pick up all that data that's on the invoices and derive all of these metrics from it. There's lots of software that can do that, including ScaleXP. There's other tools that can do it as well, but effectively we can take your data from the CRM platform, push your invoices into the accounting platform with all the fields that need to be there. And then the accounting platform can send those invoices out when they need to be sent out, with a quick kind of check from the finance team to make sure that all the data is exactly correct. So you can have a very streamlined process that allows you to give your customers what they want very easily, have an efficient finance function, and know that those invoices are being sent out with the data that they need to have on them for your customers and in order to kind of automatically derive your metrics.
What type of underlying criteria is important to have in that CRM to make sure that the integration works properly?
Yeah, so fundamentally, it's just the data around the service period. So something like a contract start date, a contract end date, and then what I would say is like the invoice cadence. So are you sending invoices monthly? Are you sending them quarterly? Are you sending them annually? Those three data points are the most three data points that you need to kind of capture in your CRM system to make sure that that invoicing is efficient.
Okay. And in terms of internal controls, we covered a few just by talking about process. What are the really good internal controls to consider when it comes to revenue and AR? accounts receivable, in other words?
Well, I think the best practice is no matter kind of where your invoicing information originates, so it can originate in a CRM system or somewhere else in your own backend system. It is always best practice to get that data into the accounting system and to have kind of a check for the invoices were sent out. The finance team most typically does those checks. What they're looking for is, are all of the accounts, the general ledger accounts correct? Once again, that is a gold mine in terms of data. Are your tax rates correct? If the invoices themselves are correct, you can automate so much downstream from that, that it's just that one check when the invoices are sent that really allows you to kind of capture then the data and kind of use it in everything from your tax returns to your metric calculations.
And do you have any stories from, a lot of founders that could be listening to us today or maybe going into a fundraising round, or they have a board meeting every month to go over financials? Any red flags that could come up from having a poor process around invoicing and revenue that usually, lands into red flags when it comes to these meetings? Any stories that you may have or examples or things to avoid?
Yeah, absolutely. Well, I think every single founder who has ever fundraised will know that, quite frankly, having the data at their fingertips is critical. And especially in this market, the expectation is that you know your MRR, you know your ARR. And certainly if you're Series A or beyond, I think there's an additional expectation that you know things like your retention, your churn, your average revenue per customer, your net revenue retention. So the first lesson is go into a funding round with your data organized and this information at your fingertips. VCs are ever more hungry for the right metrics, and the expectations are always going up. They're never going down. So whatever the questions were that you were asked in your last funding round, that will be the starting point for this funding round. And you need to be prepared to go kind of one level deeper. So just to give some examples, let's say you're raising a Series A. So Series A, I would say minimum expectations are you need to know your ARR, your annual recurring revenue, your monthly recurring revenue, your customer acquisition cost, and probably your lifetime value. You get to Series B, and then you can have expectations around your net revenue retention, your customer acquisition cost by channel, your lifetime value per customer segment. So it's almost like peeling an onion. The more you grow, the richer your data needs to be. And you absolutely need to have your fingers on all those numbers kind of at the start of a fundraising round.
Absolutely. This is golden. To wrap it up, I think I really want to hear more from you about ScaleXP. How does ScaleXP help put all of these data together and help founders and finance team, really, just like Cypher, the Cypher finance team, generate these reports and metrics?
So we plug directly into the accounting systems like a Xero or QuickBooks, and we automatically pull all the invoices and all the bills from the accounting system. AI is then used to read the bills and the invoices and then to categorize the revenue recognition periods. So it's automatically pulled from the invoices using what the invoice says. No retyping, no data entry. We then have some what we call a metric calculation engine that sits alongside that. So all of these metrics that we're referring to are derived automatically from your invoices. The beauty of this is that if you take let's call it a complex metric, like net revenue retention, maybe in your Series A, your VC is going to be impressed if you know your net revenue retention off the top of your head. You get to your Series B and you need to know your net revenue retention for your key customer segments. You get to your Series C, and then you have even more complex and well-defined customer segments. So the system is able to drive all of those metrics, following you along your trajectory, Series A, Series B, Series C, with these fully automated metrics that become deeper and deeper as you grow and you just establish your customer segments and the kind of key data that you need to track that's fueling your growth.
Yeah, I agree. And I think it's really important to start this early on, right? Just because of the level of complexity that happens with growth, just like you explained it from Series A to B to C. That's great. And also, I think it's important to understand, have that expertise to set up the right revenue recognition, because I do see a lot of mistakes made there. It is You as a chartered accountant and a CFO, what can you say quickly about the importance of really understanding AC 606 or IFRS 15 if you're not US based?
Yeah, absolutely. So these ASC 606 and IFRS 15 are the kind of, I'd say, the gold standard in terms of revenue recognition. So they define kind of, I would say, the rules around how revenue should be recognized, and critically, what investors will expect in terms of revenue recognition. There's a lot of detail in those accounting regulations, but fundamentally it boils down to the key principle, which is revenue should be recognized as it's earned. Um, and, depending on the business model, if it's hardware, if it's implementation fees, if it's usage, if it's subscription, there's slight nuances in each of these rules. But effectively, the end game is to kind of fully automate based on these rules so that A, your revenue recognition is correct and you know how much your business is actually earning every month. B, you're meeting investors' expectations. And C, you're really building a platform that kind of allows your entire team to kind of understand business performance. So yes, it's absolutely critical to get it right kind of early on, because I guess the other thing is that, when I talk to investors, once you have investment, it is also the kind of game about making sure that those investors want to follow on. And there is nothing worse than, going into a board meeting, presenting some numbers. So your board directors ask a question or two, and then you have egg on your face because your numbers weren't quite right. You weren't quite on the detail. Quite frankly, it's fundamentally undermining your credibility. And undermining your credibility means that when you come to the next fundraising round, those investors who should be there signing up first are least likely to do so. So it is, it's easy to kind of think, oh, I'm just going to skate by this. I'm not going to pay too much attention to it. But it is a very dangerous game
Fair.
because, I'd say everybody can probably get one free pass in terms of not quite having their numbers right at the board meeting. But once it happens 2 or 3 times, they're kind of, moving you into the problem bucket. And that's never worth it because you will absolutely regret that when it comes to the next fundraising round. They'll be very polite, but they'll give you a polite no. And then you're kind of hitting the pavement to raise money again. And, without much backing from your current investors. And that's not a fun place to be.
100%. I always say that there's three human KPIs to have when you're fundraising, which is credibility, confidence, and emotional intelligence. But credibility is number one.
Absolutely. 100%. Yes, I completely agree. I love that.
Thank you. Well, thank you, Susan, so much. I think this was really practical and very insightful. I would encourage that every founder of a SaaS company to check out ScaleXP and also to seek help when they don't understand things like revenue recognition or AC 606. There are other people that are experts in these matters. There's also a ton of content on the ScaleXP website that I would encourage everyone to read, especially on when it comes to metrics. So Susan, this is why I was really excited to have you here today. I knew that it was going to be a very insightful conversation. And cheers to the next episode. I'm sure there is a ton more topics that we can cover together.
Perfect. Well, it was such a pleasure. Thank you so much, Selma.
Thank you.